It is said that the real student loan crisis is the one Obama created. A new report finds that 27.3% of student loans are delinquent. Why does this matter? Because thanks to President Obama, about $1 trillion of student loan debt is owed to the federal government. Student loan debt is getting heavier, not just in terms of total amount owed, but also in interest rates. Over the past 2 years, rates have skyrocketed by a whole 2.24 percentage points. That translates to an 81.5% increase for undergraduate loans and a not-so-shabby 52% jump for graduate loans. So, what's fueling this fire? Part of it stems from a shift in perspective. After a decade of rock-bottom interest rates, anything seems high, but there's more to the story than meets the eye. Let's get into the hidden truths about student loan repayment, the things they don't want you to know. A glimmer of hope flickered with the recent student loan forgiveness plans. But a stubborn reality persists. The cycle of student loan debt keeps churning. Even with forgiveness programs, millions of new students will inevitably take on the burden of loans each year. The 2024-25 academic year is upon us, and the process for many students has already begun. This involves navigating college choices, financial aid applications, and the dreaded task of figuring out how to bridge the gap between scholarships and grants and the actual cost of education. This is precisely where the crux of the student loan debt issue lies. Collectively, we're witnessing a trend of excessive borrowing. Students and their families are taking on staggering amounts of debt to pursue degrees that may not always guarantee a strong return on investment. Let's illustrate this with some hard numbers. According to Statista, the projected new student loan total for the upcoming academic year sits at nearly $100 billion, a slight increase from the previous year's $98 billion. While this may seem like a marginal jump, you should know that the Biden administration recently announced a total of $138 billion forgiven in student loans throughout his presidency. So, the new loans issued in a single year are nearing the amount of debt canceled during an entire presidential term. This hard comparison shows us nothing but the ongoing nature of the student loan debt crisis. We're playing a game of catch-up, with new debt generation outpacing forgiveness efforts. It's a cycle we desperately need to break. It takes us to a time before the Education Reform Act of 2010, when Barack Obama took a significant step, making student loans a federal responsibility. Back then, interest rates were a different story entirely. But why did the government step in, and how does this connect to the ever-present push for college degrees? Prior to 2010, student loans were primarily issued by private lenders. This meant interest rates fluctuated based on market conditions and the borrower's creditworthiness. While some students secured favorable rates, others faced a much steeper climb. This variability presented a challenge. For students, it created uncertainty around the true cost of their education. For the government, it meant a potentially educated workforce burdened by debt, hindering their ability to contribute fully to the economy. Here's where the government's involvement intertwines with the college enrollment push. By taking control of student loans through the 2010 Act, the government aimed to achieve several things. Firstly, it standardized interest rates, offering more predictability for borrowers. Secondly, it ensured wider loan access, potentially increasing college enrollment. This aligned with a long-standing belief in the American dream, a college degree as a pathway to success. Higher education was seen as a ticket to a better job, higher income, and a more stable future. The government, in a sense, was fueling the engine of college enrollment by making loans readily available. However, this approach had unforeseen consequences. With easier access to loans, the cost of college skyrocketed. Universities, no longer needing to compete as fiercely for students who might struggle with private loan rates, saw an opportunity to raise tuition. The abundance of federal loans fueled this rise, creating a vicious cycle. Students with guaranteed loans felt less pressure to consider the true cost-benefit of their chosen degrees. This, unfortunately, led to a situation where many ended up with significant debt for degrees that didn't necessarily translate into high-paying jobs. This ultimately created a system where debt became the norm, and debt became the norm for a reason, and a major culprit is the ever-rising cost of higher education. Like, think of it, attending a public 4-year college for the 2023-24 academic year sets you back an average of $11,260, a whole $270 more than the previous year. That's just in-state tuition. Public universities might seem like the budget-friendly option, but a closer look reveals a different story. Out-of-state tuition at these institutions soared to $29,150 this year, a hefty $850 jump. And let's not forget private schools. The average price tag for a private nonprofit 4-year college sits at a staggering $41,550, a $1,600 increase compared to just a year ago. Remember, these figures only account for tuition and fees. Room and board add another layer of expense. The sticker shock is certainly a factor, but there's more to the story. Sometimes the very process of choosing a college can lead students down a path paved with debt. Imagine this scenario. A student, starry-eyed and fueled by dreams, creates a list of dream schools, applies to a bunch, and gets accepted to a few. Only then do they grapple with the harsh reality of affording their top choice. Chris Keavany, CEO of a student loan company, highlights this all-too-common situation. He said that many families prioritize emotions over financial sense when it comes to college decisions. This translates to chasing dream fields and schools, regardless of cost, and ultimately borrowing whatever it takes to get that coveted diploma. The crux of the issue is exceeding borrowing limits relative to future earnings. While some might argue the student debt crisis is more complex, a graduate with $100,000 in debt who lands a high-paying job shouldn't face crippling repayment burdens. However, the reality is often bleaker. Students burdened with excessive debt face a domino effect of negative consequences. It goes beyond simply having less money for fun activities. This is why graduates saddled with debt often delay major life milestones, like buying a home, saving for retirement, or even starting a family. The impact ripples outwards, affecting families as well. Parents who co-sign student loans can see their own retirement plans jeopardized, potentially having to delay or even forgo their golden years. The rising cost of college isn't just a financial burden, it's a force shaping the futures of students, families, and ultimately, the entire economy. So, how do you navigate this process? And what should you consider when signing up for a student loan? First, exhaust all scholarship and grant opportunities. Free money is always the best kind. Apply for scholarships and grants offered by your school, state, and even national organizations. Every dollar you get in free aid reduces your reliance on loans. Next, explore federal loan options before private loans. Federal loans typically offer lower interest rates and better repayment terms than private loans. Make the most of federal loan options like Stafford loans and Direct Plus loans before considering private lenders. And trust us on this one is really important. Please borrow only what you need. It's tempting to max out your loan eligibility, but resist the urge. Only borrow what you absolutely need to cover tuition, fees, and essential living expenses. Remember, this debt will follow you for years to come. Create a realistic budget and stick to it. Also, understand repayment options. Before signing on the dotted line, familiarize yourself with the different repayment plans available. Consider factors like your expected income and financial goals when choosing a plan. Many plans offer income-based repayment options, which can make managing your debt more manageable. And look for cosigner options strategically. A cosigner with good credit can help you secure a lower interest rate. However, choose a cosigner wisely. They're legally responsible for the loan if you default. Cosigning can strain relationships, so ensure open communication and a clear understanding of the risks involved. Now, let's explore alternative paths to a bright future beyond the traditional 4-year college degree. Remember, a college education isn't the only route to success. Here are some exciting options to consider. Community colleges are a fantastic option for students looking to save money while laying the groundwork for a successful future. You can knock out many of your general education requirements at a community college for a fraction of the cost compared to a 4-year university. This allows you to focus on more specialized courses and potentially graduate with less debt when you transfer to a university. Let's say you're set on a 4-year degree but want to be financially savvy. Consider completing your general education courses at a community college. These foundational courses often cover subjects like English, math, history, and social sciences. Community colleges typically offer these courses at much lower tuition rates than universities. By fulfilling these requirements at a community college, you can potentially save thousands of dollars. Then you can seamlessly transfer those credits to a 4-year university to complete your bachelor's degree. This community college to university pathway allows you to enjoy the benefits of a traditional university experience without the initial financial burden. But remember, not all credits transfer seamlessly, so make sure to check with your desired 4-year university beforehand to ensure your community college courses will be accepted. This can be done by utilizing transfer articulation agreements between institutions or by speaking directly with a university advisor. Next on our list are trade schools. Trade schools provide specialized training in skilled trades like carpentry, welding, and HVAC repair. These programs are often shorter and more affordable than college degrees, and graduates can enter the workforce with valuable technical skills. Don't forget apprenticeships. Apprenticeships offer valuable on-the-job training combined with classroom learning. You can earn a living while acquiring practical skills in a variety of fields, such as construction, manufacturing, and healthcare. A bright future doesn't hinge solely on a traditional college education. You can explore your options, weigh the financial implications, and choose a path you can reach without the burden of debt. Now, if you are in debt and need to repay, there are a variety of repayment plans available, and understanding them can help you choose the one that best fits your financial situation. Let's start with the simpler options: the standard, graduated, and extended repayment plans. These plans are straightforward. You make a fixed monthly payment over a set period. The standard plan. Think of this as the vanilla ice cream of repayment plans. Reliable and predictable. You make the same monthly payment for 10 years, and then you're done. This plan is ideal if you have a steady income and aren't eligible for loan forgiveness programs. The downside is that your payments will likely be higher than with other plans, but you'll also end up paying less interest overall. Now, for the plans we are not a huge fan of: the graduated repayment plan and the extended repayment plan. The graduated repayment plan. This plan might seem tempting at first. Your payments start small and gradually increase over time, stretching the repayment period to 10-30 years. Sounds manageable, right? Well, the longer you take to pay, the more interest you accrue. Choosing a longer term like 30 years can significantly inflate your total loan cost. In most cases, you're better off with an income-driven plan if you need lower monthly payments. The extended repayment plan. This plan stretches the repayment period to a whopping 25 years, with lower monthly payments compared to the standard plan. Again, the upside is temporary. You'll end up paying a lot more in interest. If you need a lower payment, consider income-driven plans instead. This one is really interesting. Income-driven repayment plans. These plans tailor your monthly payments to your income and family size. This can be a lifesaver if you're struggling to afford your current payments. There are 4 IDR plans, each with slightly different details. Repay plan, revised pay as you earn. This could be your favorite IDR plan. You pay 10% of your discretionary income and any remaining balance is forgiven after 20 years, undergraduate loans, or 25 years, graduate loans. There's even a sweet perk. If your monthly payment is less than the accruing interest, the government will help cover some of that interest. Income Contingent Repayment, ICR. This plan isn't anyone's top choice because your payment can be as high as 20% of your discretionary income, and forgiveness takes a full 25 years. However, it's the only IDR plan available for parents who took out PLUS loans. Pay plan, pay as you earn. This plan is similar to Repay, but with stricter eligibility requirements. You need to demonstrate financial hardship and meet certain loan disbursement dates. However, if you qualify, the benefits are the same. 10% payments and forgiveness after 20 years. Income-based repayment, IBR. Borrowers who entered repayment before July 1, 2014 qualify for this plan. It works similarly to Repay, with 10% payments and 25-year forgiveness, but with some key differences. It's totally your choice. The best option depends on your income and future goals. You can use these websites to know things better. First is Federal Student Aid website. This website has a loan simulator tool that allows you to estimate your payments under different plans. And the next is My Student Loan Forgiveness Cheat Sheet. This resource provides an overview of various loan forgiveness programs. So, know that the first step is to be informed and choose a plan that sets you up for financial success in the long run. Also, don't hesitate to reach out to a financial advisor if you need personalized guidance. You've got this.